Hi everyone, this is Jitan here from Learn to Trade. We've actually been around since 2003 helping traders on our live trading floor on a one-to-one basis to excel in their trading career. And that's exactly what I'm looking to do here in this TradersTV video series. In the last episode, we looked at the SMARTCHARTS platform and we looked at specifically trade sizing and how it's so much simpler using technology to your advantage. Because trade sizing is one of the most important parts of trading. Now, if you missed that video, be sure to look below at the playlist to catch up on all the different episodes. In today's video, we're going to be looking at reward to risk and understanding how to calculate reward to risk and how to separate yourself from a retail trader to an institutional trader. Many of you might not know this, but most retail traders think they can trade with a 90% success rate, when actually most funds and most institutional players are able to lose trades or lose more trades than they win, but still make a return. And that's exactly what we're going to look at right now. If you recall in the last video, we talked about the 4 different types of risk management. We had trade sizing, reward to risk, market risk, and portfolio risk. Today, we're going to specifically talk about reward to risk. It's actually one of the most important parts of trading. Usually, we get a lot of people with unrealistic expectations. There's a lot of people out there saying, oh, I have a 90% success rate, come and learn this strategy. It wins 90% of the time. And what you'll come to realize is, through a slide that I'm going to show you in a couple of minutes, is the fact that a 90% success rate is just unrealistic in the long term. Okay? The key question to ask yourself is, how do institutions make money when actually most of the time they get their trades wrong more times than they get it right? And this is where reward to risk comes into it. Reward to risk is going to enable you to actually lose more trades than you win, yet still make a return. Of course, we don't go into the market wanting to lose more times than we win, but it's a great risk protection to have, because sometimes you might just end up making the wrong decision. Sometimes the market may just not want to move in your direction. So it's a good safety net to have the reward to risk in our back pocket, so just in case we're getting more trades wrong than we're getting right, we're still able to turn a profit. So as you'll see here, just imagine this scenario where we wanted to buy when the market broke the one spot 34.57 level, and we want to have a stop loss to get us out of the market in case we're wrong at the one spot 33.10 level. Now what you'll see is that from the entry price to the stop loss, okay, the risk on the trade is 147 pips. So in effect, what I'm doing is risking 147 pips on this particular trade. Now in the last video, we talked about how we can convert that 147 pips to just 1% of our trading account. And it was a risk management formula that I showed you, and I also showed you in SMARTCHARTS just to show you how simple it is actually to do in the platform. But essentially, we're risking 147 pips on this particular trade example, and within that 147 pips, we'll only be risking 1% of our account. So we have our entry price, okay? We have our stop loss to get us out in case the market goes against us, and the only thing that we're missing is the target price. Okay, so in this example, if I had a target price 147 pips higher than where I'm getting in, then that would mean that I have a 1-to-1 reward to risk ratio, because I'm risking 147 pips to make 147 pips. And in effect, that will be risking 1% of our trading account to make 1%. At the bottom here, if I was going to go for a 2-to-1 reward to risk target, you can see that actually I'll be looking for 294 pips worth of profit. That's because 294 pips is twice the size of 147. Okay, so I'm risking 147 pips on the trade. If the market goes up 147 pips, I've made a 1-to-1 reward to risk ratio. So if I was risking 1%, I would be up 1% in profit. However, if it kept on going higher to our target level, which is 294 pips higher, if it got to that point, then I'll actually be up 2% worth of profit. Okay, and that will give me a reward to risk of 2-to-1. So let's have a look and see this in kind of real time in an example. So what you'll see here is the fact we went long here, okay? We decided to buy the market at this entry price, and we had a stop loss here, just in case we were wrong. So in this instance, we were risking 1% of our trading accounts, okay? Now if the market went up to this level here, then I'll be targeting a 1-to-1. So my profit will be +1, because I'm risking 1%, okay? It's gone up a reward to risk ratio of 1-to-1, so I'm in 1% profit. If it went higher and went to my target of 2-to-1, then I've made +2% profit, okay? So that's essentially what reward to risk is. Just how much reward we will be looking to get relative to the risk that we're willing to put on the table. It's not that much more difficult than that. However, now we've understood some of the basics of reward to risk and how it's calculated, here is where it's going to make a difference. Understanding win-loss ratios. Now let's have a look. So here we have something called the win-loss ratio reward to risk curve, okay? And this, by far, is probably going to be the most important chart that you're ever going to look at as a trader, okay? The reason for that is because it tells us how we can actually make a return even though we may lose more trades than we win, okay? So let's just explain what this chart is telling us. So on the left hand side, okay, here you have your percentage of winning trades, right? So this is how many trades you're winning. If I was winning 50% of the time, that means I would win 5 trades and lose 5 trades. If I was winning 80% of the time, I'll be winning 8 trades, okay, and losing only 2. If I was making 100% winning trades, then I'll be winning 10 trades and not losing any, okay? You know, a 30% success rate, I'll actually only be winning 3 trades and losing 7. So this is basically your amount of winning trades in percentage terms. On the bottom here, on the horizontal axis, this is our win rate. So this is basically our reward to risk. So where it says 1 here, basically what that is telling me is a 1-to-1 reward to risk. So I would risk 1% to make 1%. I would risk 50 pips to make 50 pips. At a 2-to-1 reward to risk ratio, I'll be risking 1% to make 2%, or I'll be risking 50 pips to make 100 pips, and so on. At 3-to-1, I'll be risking 1% to make 3% return. Okay, so every time I win on a trade, I'll be winning 3%, but every time I lose in a trade, I'll be losing only 1%. So this is the reward to risk ratio. Now, what you'll see here is that there's actually a line going through the chart, or a curve, I'd rather say. And this curve is basically what you call your break-even level, okay? So I'm going to put BE here for break-even. This is your break-even point. So if we take this example of having a reward to risk of 1-to-1, okay? So you risk 1% to make 1%. As you can see here, where the line is, it's at 50%. Okay, this makes sense because if I had a 50% success rate, so I was winning 5 trades out of 10, okay, 50% success rate, winning 5 trades out of 10, and if I was risking 1% to make 1%, then on my winning trades, my 5 winning trades, I would make 5%, okay, so 5 winning trades at 1%, I've made 5% return, and on the 5 losing trades, okay, I've risked 1% each trade, I've lost 5%. So in effect, I've made nothing, I'm break even. And this is what this curve represents, it's your break even point. Okay. Now here's the myth. There's a lot of people out there saying, well, I've got a 90% success rate. Okay, a 90% success rate. And that basically would put them all the way over here. Right? Now, as you'll see, with this equity curve, yeah, anything below this, it means you're losing money. Okay, anything below that equity curve, or this curve here, it means you're losing money. Anything above it, that means you're making money. So clearly we want to be above this curve. Okay, so anyone who tells you they have a 90% success rate, okay, that means that in order for them to be making money, yeah, they'll be actually risking probably only a half per trade. Okay, so that means that they'll be looking as a reward for only half. So they'll be risking 1% to make 0.5% back, right? It's what we call inverse reward to risk. Because actually, if they get it wrong, they need to be right quite a fair amount of time for them to be actually making a return, okay? So the key here is at a 90% win rate, okay, that means they're winning 9 times out of 10. But in order to achieve that, most of the systems that I've seen, is the fact that they're getting a 90% success rate. It means they're risking 1%, yep, to make 0.5% return, right? So every time they lose 1. Every time they win, they only make a half. Now, this can work in the short term, okay? And it can work in the short term. But realistically, do you think any institutions, any large hedge funds, any professional traders who do this for a living go into the market expecting to be right 90% of the time? You know, can you really have a solid trading plan based around the fact you have to win 90% of the time? I'm going to let you into a little secret here. Some of the best known funds in the world and the most biggest professional traders, they actually get it wrong more times than they get it right. Okay, most of them only have a 30 to 40% success rate on their trades. Now just think about that. Big difference from a retail trader to actually a professional institutional trader. Retail traders, they want to be right all the time because that's how we've grown up. You know, winning is good. Yeah, the more we win, the more times we're right, the better off we're going to be. But that's why trading is a skill like any other. Okay, because actually in this game you can afford to be wrong more times than you get it right and still make money. The key is reward to risk. How much are you making on the trades that you get right? So most funds have a success rate of 30-40%, right? That means that they're actually trading at higher reward to risk. So really they're trading at 2-to-1, 3-to-1 reward to risk. Because as you'll see here, on a 3-to-1, well, let's say 2-to-1, okay? On a 2-to-1 reward to risk ratio, so that means for every 1% I risk, okay, on every winning trade I'm going to make 2%, on every losing trade I'm only going to lose 1%. So each time I win, I'm making double what I've risked, okay? So that means you actually only need to get it right around 35% of the time. If you're getting it right only 40% of the time, so you're winning 4 trades but you're losing 6, you're actually still making money. Because remember, on this side of the curve, yeah, you're in profit. On a 3-to-1 reward to risk ratio, if you get it right just 30% of the time, okay, so if you actually only get 3 winning trades and you lose 7 trades, you're actually still making profit. You're still making a return because you're on the right side of this curve. Now the question is this: the people you're trading against, the beauty about the trading world and the financial markets is that when you trade, you're trading along with all the other professional traders in the world, okay? The traders from Barclays, you know, the big hedge fund traders sitting there in their Wall Street offices. You're trading with them or you're trading against them, okay? They can't afford to go into the market managing millions, billions of dollars expecting to be right all the time. So they go for high reward to risk. Why should it be any different for any other trader? Too often I see people wanting to have a very high success rate, and it's great. Sometimes, some months, we have a very high win rate, a very high success rate. We might be getting it right 8 times out of 10, and that's great. But I can't afford to run a trading business and to be a full-time trader expecting to be right all the time, because sometimes things just aren't going to go our way. But the beauty is, because of the reward to risk ratios, yeah, we can actually afford to lose more times than we win and actually still make a return. And this is just one of the most important parts of trading that a lot of retail traders just fail to grasp, okay? The key to me is always has to be reward to risk, because it just gives you that room to breathe. It just gives you that margin of error, okay? We try to get it right all the time, but we don't have to. We don't have that pressure. And as we all know, pressure can be a killer. It was actually George Soros billionaire trader, made over $1 billion trading against the Bank of England, and he made that just in a couple of days. Okay, he most famously quoted, "It's not how much money you lose on a trade, but it's how much you make when you're right on a trade that's more important." And that, my friends, is down to reward to risk. Okay, so understanding reward to risk and understanding how trading at a higher reward to risk is going to benefit you in the long run is just going to be so important, right? Before this, we looked at reward to risk and how to calculate that. And what I want to do now is just go over to the SmartCharts platform just to show you how to calculate the reward to risk by looking at the chart. Okay, so let's have a look. So here we have a chart of pound against the Australian dollar. Okay, it's actually flagged up on one of the strategies that we have here, and it's already automated the fact that there's potentially a trade setup occurring where we are right now. So suggesting we actually take a trade to the long side. And what you'll see is the blue dot here is our entry price, the red dot here is where our stop loss would be, and you can see the green dot here. This is where the green dot trading at a 1-to-1 reward to risk. So you can see the target price here, okay, which says 1 reward to risk ratio. So this is basically telling me if I was to enter the trade here and put a stop loss here, okay, this is where my 1-to-1 would be. Now again, the market is going up right now. There's a very high possibility the market could reach that area. But to get the bigger reward to risk trades, because remember with the reward to risk ratio curve, ideally we want to be trading at the higher reward to risk side, okay, 1-to-1, 2-to-1, 3-to-1 and above, just to allow us some room to breathe, just in case we get our trades wrong, okay, just in case the market doesn't want to go with us. So if I just zoom out here, what we can see is actually there is plenty of room for this trade to even push higher. There seems to be something going on around that area of resistance. So my target price down here, okay, actually may be a little bit too conservative. So what I may do is adjust it to try and get 2-to-1 reward to risk out of the trade. And even now we can see, well, okay, 2-to-1 target price would hit, but still there's a bit of room to breathe up until this level at the top. So maybe I'll go for a 3-to-1 reward to risk ratio. So all I need to put is in 3, and then suddenly this looks now a little bit better. I'll be looking to get in here, have a stop loss here, and a target here. Okay, and based on where we're trading, that doesn't seem to be out the realms of probability. Okay, there is a very high probability the market can at least get to this point here based on historical evidence, and that is reward to risk. So suddenly we've just taken one trade, and instead of going for a 1-to-1, okay, we're just trying to go for a bit more of a high reward to risk, because if it's available, we want to take it. Don't fall into the trap of following those people who tell you that they're right 90% of the time. They may get it right 90% of the time, a few days or a few weeks, but long term, it's not a consistent strategy you can rely on. Okay, and I wanted to put it out there because trading can be very simple, it can be very efficient, and it can be very profitable if you understand how the professionals do it. Okay, little tips and tools like this make your trading so much more simpler and efficient. And of course with the SmartCharts platform, it makes it a lot simpler too. So in effect, I can actually now place this order, okay, and it's telling me I'm just going to be risking just slightly less than 1% on the trade, okay, 0.99%. It's already put in my figures, my entry price, my stop loss, my take profit, okay. So you can see here, if I get the trade wrong, I'll be losing £1,600 thereabouts, but if I get the trade right, I'll be making £4,827 thereabouts, okay, and that is reward to risk. And if I just place that order there, you won't get that there, but you can now see that we have the order waiting in the system. If the market takes out my entry price, great, I'm in the trade. My stop loss is down here. In case I'm wrong, fine, I'll lose 1%. But if I get it right, there's a possibility of making 3 times my return on this. If I traded like this over the next 10 trades, then I only need to get it right 3 times. I can lose 7 times. On the 3 trades I've won, I've made 3% profit, okay? So I've actually made plus 9%. And on the 7 trades I've lost, well, I've only lost 7%, okay? So I've actually made 9%, I've lost 7%, so I've actually made 2% profit overall. And I've just lost 7 trades and won 3. That, my friends, is reward to risk, and that is why reward to risk is going to be a game changer to your trading.
So I hope you enjoyed that presentation. In the next video, we're going to be talking about compounding and one of the most important questions that I always get: what returns are realistic from trading? So stay tuned. If you have any questions, feel free to leave a comment below. If you have any further questions and want to interact with our traders, then I strongly recommend you attend one of our live Forex trading seminars by clicking the link below and finding the closest one to you. I'll see you in the next video.